Welcome back, sir. It's good to see you. How's the process going? Let's start there, and then we can get into all the other good stuff. How's the interview process going?
It's going well. As far as I can tell, the Secretary has a very systematic way of going down the list and doing the interviews. As I said the other week, I had a great interview with Secretary Bessent. Talked a lot about economics, Fed policy, the Fed, balance sheet, just general stuff in the economy and financial markets. It went very quick. It was about an hour and 45 minutes. The next thing I knew, it was over. So it was a great conversation. Of course, I love those kind of conversations. I can do that all day long.
The Treasury Secretary's spoken about in the past, he wants almost a visionary, someone who looks forward, like an Alan Greenspan type, open-minded. Do you get a sense of what he means by that?
I think it's the idea of if you're looking at the data and it's always looking back at the data, the data is always kind of old, and you have to think forward, like where are you going with this stuff? I've managed to do that a couple of times with thinking about this beverage curve argument back in May of 22, that we could have the soft landing earlier this summer with the weakness in the labor market, which turned out to be true. People doubted it at the time I said it, but so I think I don't want to, brag, but it's that kind of being able to look at the data and see forward where things are going, and I think that's a critical thing he's looking for.
You were certainly vindicated. The president was obviously excited about the fact the Fed finally was cutting interest rates. Have you spoken to him at all?
No, I have not.
Is that on the schedule?
I don't know. That's up to Secretary Bessent.
We're going to find out soon, hopefully. We'll talk to the man himself, the Treasury Secretary, hopefully later on in a month. I want to talk about the meeting that takes place at the end of this month as well. You were pretty clear going into the last meeting. You delivered a speech, and I believe the title was "Let's Get On With It."
Yep.
Are you advocating for the same thing at this meeting?
Yeah, I think it's the right thing to do. Back then, there was an issue of whether you go 50 or 25, and I argued we could do 25 and see how the data comes in. Of course, we're not getting much data, and then we can think about the next 25. So in the last 6 weeks, I don't think a lot has changed. We're not getting the public data, but all the private sector data that we're getting, Beige Book yesterday, everything we're getting is telling roughly the same story. The labor market's weak. Growth seems to be on the stronger side, which is a bit of a puzzle right now, because you can't have a really strong growing economy and negative job growth or zero job growth. And people talk about productivity, but AI hasn't had that effect yet on the labor market or productivity. It will down the road, I think, but not right away. So I don't think that's the story that's driving it. So in that case, one of these things has to move, right? Either GDP numbers start coming back down or the labor market rebounds. You just can't have growing economy and very weak labor market. They just don't go together.
In the meantime, do you just continue to reduce interest rates meeting by meeting as you wait to see what's going on? What's your overall approach, and what do you think about that?
That's exactly what I've been arguing. Is since we don't know which way this is going to break, if the labor market rebounds, there's less of pressure for cutting rates. If the growth comes back down, there's more pressure for cutting rates. You don't want to make a mistake. So the way to avoid that is to go cautiously or carefully and do 25, wait and see what happens, and then you can get a better idea of what to do. But if you've already started the process, you're providing whatever initial support for the labor market that you feel is necessary.
So we've had this obvious step down in payrolls growth. It's pretty clear.
Yeah.
It feels like that alone, though, might be an outlier compared to everything else that's going on in the economy. You yourself just acknowledged that. What do you think is behind that? And can that persist?
That's the thing. When I've talked to private sector CEOs about hiring, I mean, we typically get a couple things. Maybe early part of the summer, there was a lot of uncertainty about tariffs. We're just holding off on doing anything. One of the things I heard is firms were going to have to pay the tariffs. One easy way to do that is just not hire. Take all the labor savings to pay off whatever the tariffs were. So that was one thing. Then you have this AI story, which was people like, we don't know if we're going to need to hire, but we're going to wait and find out. We're not going to go out and hire a lot of people right away. So I think the tariff uncertainty, paying for tariffs, trying to sort out what AI really is going to do, kind of put firms on their back foot. Now, that's what I mean. Either they decide the AI is not going to be in the near term the big job replacement that they thought, and they're going to have to start hiring, and it comes back, tariff uncertainty goes down. All of those things could lead to a rebound. On the other hand, if GDP starts softening, it's not as strong as we think, that somehow the data is a kind of a mirage right now. Then the labor market is telling you things are just not as good as you think. Now, the financial markets are the big puzzle. I mean, I'm not the only one. How much of this is just a big boom in AI and everything else is marginal? I've kind of been arguing there's a big difference between the financial conditions for corporate America and financial conditions for Main Street America. If you're Main Street America, you're looking at mortgages over 6%, very expensive housing, car loans over 7%, credit card interest rates in the 20s. These are not loose financial conditions for American households. So when we look at the financial markets, you're seeing a lot of when people talk about credit spreads and all that. I don't think most American households care what the credit spread between corporates and treasuries are. That doesn't really, unless it shows up in mortgages. So I think there's this is one of the things that I find kind of puzzling right now is there's just always these dichotomies between things. If you look at AI, if you take out anything data center AI related, business fixed investment is turning down. It's not widespread. All this investment is not widespread across. There's a real reallocation from kind of everything else into AI. So there's this bifurcation in so many ways that make kind of reading the economy tough right now.
How much influence do you have on one versus the other? Financial conditions on Main Street versus Wall Street. Wall Street's immediate. Wall Street's gone. It's off to the races. Yeah. Can you really influence financial conditions on Main Street?
Well, that's kind of what we hope. If you think about cutting rates, which we're doing and I think we'll continue doing, that does have a pass-through to the 10-year. And the 10-year is often the anchor for pricing mortgages. So the 10-year is down to like 4%. It's come down from 4.5%. That's about 0.5% off. If it were to continue drifting below 4%, you'll start seeing some downward pressure for certainly mortgages. Auto loans are kind of a different thing. They're trying to figure out how to deal with tariffs on the auto industry. One thing I've heard is they got rid of a lot of cheap financing that they used to subsidize for consumers. That's going to raise the cost of financing. All these things are more tightening for Main Street America. So hopefully these things, as we go on through the rest of the year, start loosening up some.
You've been watching the programme, so you know some of the things that people say on the show. I'll just go over it briefly. Ultimately, equities at all-time highs. Gold's ripped 60% this year. You mentioned credit spreads.
Yep.
IG credit spreads at multi-decade tights. High-yield spreads near the tights of the year. And there's a theory out there that the Federal Reserve and some officials on the Fed, perhaps yourself included, have anchored their view of this economy around the step down in payrolls growth and are going to be lulled into reducing interest rates when maybe they shouldn't. And all that's going to do is fuel financial market excess. Just to give you the chance to respond to that, how would you respond to that? This idea that you run the risk of being lulled into reducing rates when maybe you shouldn't.
Well, the mandate I have from Congress is maximum employment and stable prices. It's not the financial markets. So I look at, that's why when I'm looking at the labor market. The labor market is weak. If all these loose financial conditions are going to cause a boom in excess in the U.S., we should start seeing some of that in the labor market. We're not seeing it. So a lot of this is, I think, just this is where the AI thing is. There's so much speculation on AI that it's kind of, again, this dichotomy. It's kind of overshadowing everything else that's going on. And like I said, my job is unemployment and price stability. And I think inflation will be okay. It's on up, but some of the tariff effects will come back off. But my job is about the labor market, and it's not good. So if you want me to go to Congress and say, hey, tell me to start worrying about financial conditions, and that's how I should set policy, let me know. But until they do that, I'm going to keep focusing on
let's go with the dual mandate, and let's stay with AI. And the potential that introduces some additional tension into the dual mandate, that it holds back employment, but also boosts prices. Anne-Marie was talking about what it could do to energy, all the spending, resource intensive. We had a guest on the programme talking about the same thing. Would you see that as a potential that it introduces some additional risk into the dual mandate?
Well, in terms of inflation, I mean, one of the things I was asked this question by some people in the AI sector. It was like, isn't this inflationary, all this spending we're doing? I said, yeah, but you're taking it away from other sectors. So those other sectors are seeing less demand. So this is, in my view, a lot of this is a sectoral reallocation. And if that's the case, then the increase in AI is going to be offset by other things. Now, true, energy may have a bump up, but then you just look at core, because you kind of knock out the energy part of it. And that's really what you want to do. That's why we kind of knock off energy. It's just so volatile, it gives you the wrong signals.
So, Governor,
when we look forward, when we're just looking forward.
What I hear from you is you can look through tariff-induced inflation, you can look at AI-induced inflation. Is there any inflation out there right now that you see that you are concerned about? Because we're potentially going to get a pretty hot CPI print at the end of this month.
Well, we'll see. When we take the data at the board and we have various ways we try to tease out the tariff effects, our estimate is inflation's running about 2.5%. And we're not seeing anything that's going to explode. Like I said, all this attention on AI is ignoring the fact that other stuff is softening. So demand is up in one sector, it's going down in another. Those things often, not completely, but often offset. So that's why I'm not really worried about the AI stuff. And if it really did cause some big problems in energy, like I said, just if you're thinking about future inflation, just look at core, don't bother with headline.
At the end of the month, though, you might not get the labor market report.
Right.
How difficult is it? And can you even provide outlook, meeting by meeting, in this environment?
Well, I have this joke that for those who think we're too data dependent, you're going to find out what non-data dependent policy looks like.
I'm excited.
But that's the point. We do have lots of data. Like I said, we've got lots of labor market indicators that tell us the same story. It's not good. We don't get a lot of other things as, oh, the labor market's great. So I think the data from all the sources is telling you the same story. The labor market's weak. We're getting this data, conflicting data about GDP. Like I said, the Beige Book came out. It was not like everything's rosy and booming. There could be still, in the GDP numbers, still a lot of inventory pull forward that because the China tariffs weren't finalized, so get them in, get stuff in now. So it may be that we see, GDP start to pull off at the end of the year. I think about the tax bill in that there was a lot of incentives for business fixed investment. That's great, but that applies equally to AI and non-AI. So at the end of the day, you're still deciding whether you want to go into AI investment or non-AI investment, and the AI is winning. So I don't know how much of it, how big of a help it's going to be on the non-AI kind of sectors in the economy.
You've called yourself a techno-optimist. Enjoyed the speech, by the way, yesterday. Thank you for that. I just wanted to finish on this before you run. This feels different to last year. When you came out last year and you made a big step down in interest rates and cut by 100 basis points off the back of the employment scare through the summer, this feels slightly different in your approach. How would you describe the differences between now and the approach of you and what you're advocating for on the Federal Reserve to what the committee did last year?
Well, last year we didn't have all the tariff uncertainty. We didn't have this AI thing. Unemployment was not even remotely talked about. So I'd say those are the two big differences. Like I said, I think the tariff stuff will settle out and it'll be okay. The AI thing is the concern I have with the AI, if it does, and I think it will materialize. Monetary policy is designed to deal with cyclical movements in the labor market, kind of ups and downs that come with the business cycle. But this feels like a structural change. All right, labor demand just drops and doesn't come back. That's something I can't do anything about. The Fed can't kind of adjust policy to deal with structural changes in the economy. So it's going to be a challenge to say, is anything we're seeing in the labor market from AI coming down the road, is that something the Fed can do anything about or should do anything about? Or are we just seeing kind of a typical cyclical movement where there's a hot sector and then it cools off later and everything's not quite as futuristic as you think it is? So that's, I think, for me, the biggest challenge looking forward is this a structural change or is this just a cyclical change?
Is the prudent thing to do as a risk manager just to assume it might be cyclical and cut just in case?
Yeah, I mean, if you cut and it ends up being structural, you cut. It's not going to undo whatever you did. But if it is cyclical, then you can help rebound and get the economy back on its feet, or the labor market back on its feet.